When I first discovered the stock market, it was love at first sight. It became my dream to be a professional trader. I threw together a little bit of money in order to help me do this. You can see that balance here. I knew as a trader, if I was going to make it as a professional trader, it was going to take a little bit more money than that. The question is, how much? And how much would I need to make to be considered a professional trader? Well, at the minimum, you should consider minimum wage. I have to basically take that much money and beat minimum wage. In order to do that, I need to make about $125 a day trading. I'm chronicling this journey here on the Russel Journal. I'm Russell, and this is my journal entry for Thursday, November 10th, 2023, or 2022. What is wrong with my head? Okay, well, so much for the live stream idea. Anyway, how did I do today? Let's go ahead and check out that balance. You can see I'm up $44 for today. You can see my account balance is here, is right around 220 bucks. And you can also tell that if you were watching yesterday, I was down to 177. As far as my trade goes, I put on a straddle on yesterday, or a strangle, I'm sorry, and because we had CPI data coming out, and I wasn't really positive as to what that CPI data was going to look like, and even crazier than that, I wasn't sure how the market was going to react. If you asked me yesterday, I would have assumed that we were going to sell off, go see the next leg down, but from the sea of green behind me here, you can tell that that didn't happen at all. The only things that are red on the board are your inverse ETFs, your short Qs and short Bitcoins and stuff like that. So it's all pretty interesting as to how it played out, where we ended up at the end of the day, and what happened with CPI, and going forward, really. What you're going to hear the conversation spin to is the bear market over? And I am not a great trader, not yet. I'm working on it. That's what this whole channel is about. But from my research, what I have figured out, or what I've understood from my research as to how this whole transition goes, there are a couple of things that we still have to go through in order for the bear market to end. Okay? All right. So, first of all, this is how the process goes. High inflation causes the Fed to raise interest rates. This causes securities to go down. Okay? Now, the reason why securities go down at that point is because you're getting what's called a multiple compression. Okay, this is what they call. You might want to take notes on this. I had to. All right, you're going to get a multiple compression. Okay, that means that stocks aren't really going down because the companies are considered to be valued worth less. It's just that investors are willing to pay a lower. They're not willing to pay as high of a PE ratio or as high of a multiple of their earnings to own those companies. Okay, and that is because those investors, their money it has a cost to them. And so based on their cost, there has to be a certain price point that they're willing to pay in order to own that position, to own that stock. Okay? Now, we have now had the PE compression, okay, or the multiple compression. We've had that. We've had the high inflation. We've started to see the interest rates come up. Then we have started to see we begin to see the high inflation, or the compression. Okay. Now, what's the next thing that we have to see? Well, there's two things that we need to see. We need to see, one, sales growth starting to slow. We did see this. We saw companies missing on earnings, not hugely, not incredibly bad, but some, and to some degree, which is leading us towards like where earnings are starting to pull back. And the next thing that we're really looking to see is those unemployment numbers really start to tick up, really start to climb. Now, as of right now, everything is really pointing towards the possibility of a soft landing. We don't know that that's going to happen, And this is a very delicate process, this deleveraging that we are going through. And the likelihood that you will see something break is still very, very high. Okay? And this is where, like, again, your in to be frank, your end of your bear market isn't here yet because the danger isn't past. Okay? And that is and so the things that we still have to see now, we got some layoffs coming from tech, from Facebook starting to lay off. A lot of other tech companies are starting to have the layoffs. So in the coming weeks, like probably going to be about 2 weeks before you really start to see those unemployment numbers really hit and tick up. Remember, if I got laid off this week, right? If I came in and my boss is Mark Zuckerberg and he laid me off this week and I am going for unemployment, okay? I will not report my unemployment until next Monday, okay? I will call on Monday and report that I am unemployed, and I will not, and then those numbers won't be reported for that Thursday. They will be reported for the following Thursday, okay? So you still have roughly 2 weeks before we can see those numbers actually begin to tick up, okay? So we need to see that unemployment, and we need to continue to see those sales decline. Now, we did get some of that. We got the retail sales numbers back in October, and they were showing weakness. They're coming down. And so what we can begin to see is we're beginning to see inflation abate. Now, the thing that we are interested in, we got the CPI report this morning, okay? Year-over-year inflation came in at 7.7%. That is a good sign, okay? We're down below the 8%. We've been moving backwards. Very good. The core CPI came in at 6.3%, okay? Down from the 6.6% that we saw last month, okay? So the numbers are moving in the right direction as of now. However, if you go back to June, you had one report in June that was a good CPI report, or showed the numbers were abating. One is not enough. You need more than one in a row. So we will be interested to see into December what that CPI does and what it says. And you've had some volatility in some of these areas. You've had some volatility in food. You've had some volatility in oil and energy and things of that nature. So really, we still need to get through that one CPI report before you can really start to say, well, it's maybe the end of the bear market. And even then, there's still a few things left in the pipeline that have to get worked out. The market has to correct for. For example, if you've been paying attention to any of the wholesale inventory reports, okay, we're getting larger and larger wholesale inventories. You are looking at companies that are sitting on top of large quantities of inventories of goods that are now maybe 12 months old, okay, and that they're going to have to dump onto the market. Now, this is Kathy Wood's sort of idea that we will come into a deflationary recession, not an inflationary recession, right? And what she thinks is going to happen is we're going to get all of those things opened up. We're going to get those pipelines opened up. We're going to get those, not pipelines, but the supply lines for all of our goods opened up. And all of a sudden, a wave is going to come in and just take everything out, okay? Now, this is a little bit hard to understand, hard to believe. Again, if it does happen, and this is why my thesis for a stock market crash, okay? And we'll talk a little bit about that in 1 second, but stock market crash is for January, okay? I believe based on the technical patterns, I have a video up called The Kiss of Death that you should go back and watch, and it will sort of explain this to you, that you have that process play out, and after you have the move of the kiss, you have the death, and then there's 2 months usually right after that are quasi good months before you get the actual crash in the market. Now, I look at this and I have to assign reason to it, And my reason is that January is the slowest retail month of the year. Inventories can start to get worked out, and unemployment can start to get really, really high in January due to the end of seasonal, like holiday seasonal labor. Okay, there are companies like Costco and such that hire people only through Christmas, and once Christmas is done, those people are gone, and so you begin to see some uptick in unemployment rates. Okay, so all of this, again, at the moment, if those inventories do open up and they're stuck with a massive supply of inventory that needs to be exited, this will make for a glut of supply, and this will bring a crash, okay, to the market. Now, this may or may not happen, okay, which leads me to one other thing that I want to talk about, okay. When you are a trader, as a trader, this is as I have understood it, as I've come to get to know it, you build a thesis for everything, okay? And the thing is I have a bull thesis for a soft landing, okay? I do not have a bull thesis for just a Fed pivot, okay? A Fed pivot does not mean that the S&P can go back up to all-time highs, okay? It does not mean that. And as a matter of fact, just because of a pivot does not mean that it can go up there in like a couple of days, couple of weeks, couple of months. It cannot, okay? And the reason is because the cost of that money, right, even if the Fed backs off, you're still looking at a 4% interest rate, okay? The S&P, the SPY, the ticker I trade alone, is at its peak is like $480, right around that's around the top, okay? In order to get it there, interest rates had to be at 0.02 or 0.25%. The Fed funds rate had to be down there. So you tell me how from 4% interest Fed funds rate, even if you just stay there, you can go back up to 480. Why? How? What? The only way that happens is if retail is a bunch of idiots. Okay? If retail drives it up there, they can, because they don't consider, retail does not consider the cost of money in its investment. Okay? The only people who do are those major funds. And they will push it pretty high. They will push it. But the thing is at 4%, you cannot, and here's the deal. The S&P could be at the 4,800 level, right? Or SPY could be at $480, right? It could go up there. Absolutely. Right? But the thing is the market internals cannot support that, okay? Because that would mean that Amazon has to go back up. That would mean that Microsoft has to go back up. That means, right? And I mean up to all-time highs, right? Are you going to seriously tell me that Facebook, after its metaverse fiasco, is going to turn around and go right back to $300 a share? That's going to happen. I can't. If you can come up with a thesis for that, I will absolutely listen, right? So there's no thesis for me that a Fed pivot will take us back to all-time highs. There's no thesis for that. Okay? There is a thesis in my brain for a soft landing because Powell is not, look, it sucks. It's not great. There's a lot of stuff that happened there that is wrong, broken system. But you cannot tell me that Powell is a moron. You can't tell me he's stupid. And he's a smart man working very hard to leave a lasting legacy, right? He wants to be the next Paul Volcker, right? So the thing is the that he is going to try very hard to negotiate a soft landing, to bring that about, is really a big deal. He's going to try and do that. You can build a thesis on that because you can build a thesis on any management team for any company. So if you can do that, the Fed's a private company. Why wouldn't you do that for the Fed? Right? The other thing that's really good about it is if you do wind up with a gridlock government, they'll get chopped up and the Fed can actually work. But right now, your administration is releasing oil reserves, reducing the cost, artificially reducing the cost of fuel. Not finding ways to help you stop driving. Not finding ways to help you stop spending money so inflation will come down, right? Nobody wants to do the hard thing. The easy thing is just give them oil, right? So with all of that really being said, I have a thesis for a soft landing that involves no crash. As a matter of fact, it'll be 10 years of the most epic and amazing rally you've ever seen in your entire life. That is very plausible. At the same time, you also have at the same time, you've also got plausibility for a crash. So we have a thesis for that. And that's where we look at January and where those inventories line up and where that unemployment lines up and all those things are at. Okay? So this has all been like a pretty long rant. I'm going to jump right ahead into the charts now. And we'll go look at SPY, what happened today. And we'll jump right over to the SPY daily. This is interesting. This is really interesting. And this is where I have been really trying to work on this thing called the infinity trade. And this is the reason why. Okay? All right. We go back here to this spot here. And this is the day that the market hit its all-time low, 348. And we got this nice crazy rally off, pullback, and you got this bull run. Okay? Well, you had this low here, and you had this low here. Okay? So now you had a pattern of a higher high and a lower low, okay? And then you came in here yesterday and you started setting in a lower or a lower high. So now you would have had lower highs and technically lower lows, and they turned the chart on you this morning, okay? You came in here, you pull up, and boom. Now you actually kind of have a pattern of higher highs. And tentatively, I believe that is, let me see, you look at that really quick. Yeah, it's almost like a double bottom in here, you know, off of that 18. You've got support. So your trend is technically turned up, okay? Now, where did we go? How did we do this? How did we trade today, okay? So, here you got into this mess. And you're really sitting without much trend on. You don't really have a lot of trend on the table, right? It's really counterproductive trend. So what I did is I bought a call at this upper Bollinger Band here at 393, and I bought a put at 359, which is the lower band. You're sitting here, you're looking for a break one way or the other, and you're really not wanting to risk a lot. This call up here only cost me about $30. This one down here cost me $30, and so I split it, right? And on this side, I lost. I think I sold out. Brought $3 back on this one, so I only lost 25 on this. And this one up here was up over. Well, in the end, you saw it. I was up $44 total. The other thing I want you to notice is we did exit the other call today. Took out about $28 on that. So really kind of put $60 back into the account total for the day. Was pretty interesting as far as all of that goes. Going into tomorrow's going to be a weird one because tomorrow is Veterans Day. By the way, make sure you hit the like button, subscribe, and the notification bell, because tomorrow I'm going to go through some stuff that's going to be really good. If you are a vet, if you know somebody's a vet, I'm going to explain some of the things that nobody has really talked about as to why some of our wars happened, and really some of the reasons why we're not actually thanking our vets for what they really did for us in the world. So make sure to come check out tomorrow's show. But we're going to get through this part and this. All right. So now you've got higher highs, kind of higher lows here on SPY. So you've kind of got a bull trend. Your bias is definitely up. Your momentum is up, right? So everything as of right now would be on the long side. Here's the problem now. You are at the upper Bollinger Band, okay? So this only closes outside of this band 5% of the time. Tomorrow, you have Veterans Day. It's a banking holiday, so the banks will be closed. The markets will be open, but we should not really be expecting a lot of activity in tomorrow at all. And tomorrow, I do anticipate there to be probably more selling than buying. Not that I expect this thing to come crashing down. However, where you're at with it is it's really got you in a spot of no man's land because you're at this upper Bollinger Band, so you can't go long at the Bollinger Band, okay? You have to wait for a pullback in order to get long on the Bollinger Band. So that's going to be really tough. Second of all, you are overbought down here, but you are not embedded, right? You can get long at a Bollinger Band if this has got 3 days, if it's got 3 candles inside of this, above this 80, you can get long into that. But as far as we're concerned, you got to that band, you hit the price target, now you have to wait and see what happens. You need to let it set in a new higher low for you to either get long or have it start to trend back in the other direction, okay? Now, I'm not going to make any guesses as to which way this is going to go. Again, tomorrow I would suspect there'll be profit taking into a 3-day, into some type of 3-day weekend. Okay, so I'm not looking for big opportunity coming into tomorrow. And so that's really where you're at with it. We will come back on Sunday. We'll see how tomorrow went. Look at what's going to happen on Sunday for the next week. But as far as our opportunities are up, one of the things that will be nice, the trade I'm looking for next will be the move actually back to this 18-day moving average, the mean, right in the middle of the Bollinger Bands. That's probably the next actual trade I'm going to try and set up on if we get that shot at that. The other one that I'm going to try and take a shot at again is a move back up to the 18-month moving average. My account balance is down around $200. I can pretty much guarantee that if we get a move to one of these 18s, I know how to find the move when it happens, the move to the 18. So I'm going to have to reset the account balance because I've messed around with a bunch of stuff. And so in order to do that, we're going to have to find one of those moves either back down to the 18-day moving average or up to the 18-month moving average. Or I'll keep an eye on the weekly. We'll definitely need to look at the weekly because if things really work out on the weekly, we might be able to catch the move to the upper Bollinger Band on the weekly chart. But we will do all of that analysis on Sunday and see if we can set that up for a possibility. Anyway, in the meantime, that's pretty much it for me today. Thanks for checking out the show. The Russell Journal is written, edited, hosted by me, Russell Liss. We're produced by Social Media Shows. Our executive producer is Maria Pereza. Give them a check out if you would like to put a show up just like this. They can help you, especially if you're in the Vegas area. And until tomorrow, pretend I said some sort of catch.